Dana, I know Monday mornings are tough for you. Appreciate you being here. How are you?
Oh, you got it. Hey, Dale. Sorry
Almost forgot
for
again. Huh?
yeah, no.
All right.
I just I couldn't connect for some reason, but
I was going to
I'm
send the
here.
Twitter hitman after you.
Yeah,
If you
no.
didn't show.
I'm
Anyway.
here. It just wouldn't let me connect, but I'm here.
All right.
So,
Well, big
nice
week ahead, Dana. Big
Yes,
week.
sir.
You want to show your screen and kind of tell us what's front of mind for you going into the CPI and the Fed. Are you positioned? Are you lightening up in front of it?
Yes, sir.
What sectors do you like? And are you bullish or bearish? That trend line, Dana. I want to start with this. The universal downtrend line.
Right.
That even people on Mars are watching.
Right.
From
So
the
you're talking about
all-time
the
high.
S&P? Yeah, you're talking about the S&P.
Yeah.
Right.
Isn't
Yeah,
isn't that too pat?
yeah, it's never you know how it goes. It's never that obvious, right?
Yeah.
Which is, it's this such a benefit to the instant widespread information, widespread distribution of information, and
right.
Dissemination of information. But it's also a curse because everybody knows everything now, which is why some of the traditional things that have worked well in the past, they don't work anymore. So I look at a lot of breakouts that it's not like it used to be. Now
you can't trust them.
Breakouts tend to fail, and breakdowns tend to fail, at least initially. At least they're head fakes. They shake you out, and then maybe they work, So, but the obvious things don't tend to work anymore. And it's the same thing with a lot of, stats. Us, we're all into the quants and the stats and the data.
Yeah,
that's the most important
ratios.
Thing. But and some of that, a lot of that is still useful, but some of the, like the trivial stats, like 10 out of 11 times historically this has worked out. Those types of things are not as reliable or consistent anymore.
Like Santa Claus rally.
Including that, but I don't. Some of the seasonal stuff has a lot of history to it, and there are certainly seasonal factors that there are reasons why some things do work consistently over time. So there are gentle headwinds and tailwinds to some of those seasonal factors, but certainly once those things become more widespread and well known, they stop working as well. I do have one what do I do? A new share. One reason, one bullish, I should say.
Breath. There was a breath thrust or something.
I'm trying to get a different.
All right, so you stop sharing and then you new share.
A new share.
Anyway, while you're trying to figure it out, I wanted to ask this. This is kind of consensus narrative that the lows haven't been made, that we're going to make one more. We're going to have a flush into the first quarter to take the S&Ps down to 3,100, the pre-COVID high. A lot of people using that narrative. Are you in that camp or not?
We're definitely in the camp that we're going to new lows eventually. We do think this is a bear market. No, I finally figured it out. So sorry. So on the bullish side, you have bullish seasonality, right? So this is the presidential cycle, the 4-year presidential cycle. So we have like 3 of the best quarters, including the current quarter of the whole 4-year presidential cycle. We basically started that run, so we're in the middle. We're in the middle of the first one. So seasonally speaking, this is the most bullish time of the whole, 4-year presidential cycle.
So we could be good till the spring.
That takes us through the first half of next year. So that is one. That's one bullish factor. But certainly that, like I said, seasonality is kind of a gentle breeze in your face or at your back. It certainly pales in comparison to, for example, some the macro environment and the technical environment. So that would not be obviously the reason why we direct our investments. For us, we have a technical or
Right.
quantitative model that it's all data-based, it's all data from the market. It has a heavy bent on breadth statistics, on money flow statistics. So that's going to direct our investment.
Wasn't there recently a very positive breadth thrust?
There, you know what? Looking back in let me move this out. You had in the summer. Yeah. And that's another thing that said, okay, every time you've had this breadth thrust in the past, we've gone on to new highs. Guess what? That failed. You also had, back here in July, in that June to August rally, every time we've recovered more than half, 50% of the downtrend, we've gone on to new highs. Guess what? That failed instantly too. So those types of things are not working as much anymore. I will say, you asked me if how we're positioned, if we're bullish or bearish. Our risk model did give a buy signal in the latter half of October. Had some strong breadth readings off of that low, like you mentioned. It's still on a buy signal, so our bias is still to the upside. Those signals tend to last 2 to 6 months. So right now, our bias is still to the upside, but as you can see by the chart of the S&P, the biggest headwind right now is simply, to the technical picture. We've got plenty of resistance to work through on the S&P and other areas of the market, especially the growth sector, the NASDAQ, tech sector. Those they have tons of resistance to work through if we were, for example, going to go make a run at the old highs. So technically, we have a lot of challenges. From a breadth perspective, from our quantitative perspective, again, the benefit of the doubt still to the upside, but our indicators are even slowing down and not showing that momentum that they used to. But here's one, the equal weight S&P 500. So this index, look at the market is more correlated to our risk model, to our quantitative model. And you can see how much stronger it is technically than the S&P, than the cap weighted S&P. So this ticker symbol is RSP on this ETF. So sitting above most levels of key technical levels of support, sitting right on that 200-day average. Some short-term Fibonacci support did fail right at that 61 retracement from the highs. So again, this look has some technical challenges as well, but better position as those breadth statistics would have suggested. So this one area of the market, obviously, that is a little bit better positioned and is a better tell for the overall market. There are how many tens of thousands of ETFs or investment vehicles out there. You don't have to always be invested in the S&P 500, which is one of our two tenets of our investment philosophy. Is the overall market going up? If it is, then where do you want to be invested? And we want to be invested in the strongest areas of the market. We don't want to be diversified across all areas. We want to be heavily concentrated in those areas of the market that are working best. So you find those areas of the market that are technically better positioned, like this one.
All right. How about since we last talked, there's been a shift in direction in the dollar in a fairly big way, 10 big figs from the all-time high. Do you believe this is a trend change, and should we look at that as a positive for risk? It used to be. Do you think it still would be if that continues?
It has been for the last couple of months, obviously. So if you're into that kind of intermarket analysis, that would be probably a positive. But again, those types of correlations, correlative
they work,
investment,
they don't work.
they work until they don't. Sometimes gold and the dollar go in the same direction. It's not reliable. Our philosophy is it's hard enough, or our thinking is it's hard enough to figure out the direction of one market, let alone figure out the direction of a market based on the direction of a different market. You know what I mean?
Did your stuff get you
You know
long?
what I mean?
Yeah. Did your stuff get you long miners? They came to life over the last few months.
We have a long position on miners. Our bias is certainly to the upside now in the precious metals complex. But you asked about the dollar. I think overall the major trend is still higher. Obviously, in the intermediate term, the shorter term, the trend is lower. I would say we started buying some more dollar or in the last week or so. You can see, we're outside of our quantitative model. We use some charting techniques for entry and exit positions, and we do rely quite a bit on Fibonacci levels. And what we like to see is kind of a cluster, a confluence of Fibonacci levels line up in the same area. So if you go back to the lows, the dollar low in 2008, that 23 retracement was the first key Fibonacci level to look at. We're testing that level right now. It also lines up with the 38 retracement from the COVID low, or the 2020 low, right in this general vicinity. So around this 104 to 105 level, I think is important support. So we've been buying the dollar for a counter trend move. Certainly, it's got some. If we get up towards that 109, 110 level, it's got some resistance to get through right there. But for a trade, definitely that's a position we've been buying over the last few days as we've tested some support. So, yeah.
What about, are you a believer in this recent, the long end of the market, the bond in yields, the bond market, TLTs had one heck of a run? Yeah. Would you buy like a 50% retracement in bonds if it happened?
Okay. So long term, and we've talked about this, I think, in the past, long term, we think interest rates have bottomed in that long. There's about a 60-year interest rate cycle. We think that bottomed in 2020. So we think interest rates go up for a couple decades. Nothing goes up in a straight line. So if you scroll back again, here's the 10-year yield from the top in 1981. That first Fibonacci level would be that 23 retracement, again around that 4%, 415 level. So we were short bonds most of the year.
Yeah.
Rallied up, hit that first key level, just above 4%. So we did go long. We're still long for a trade. We did sell a lot of our long position as we pulled back and hit the first, that 23% from the COVID lows of 2020. So right around that 340 level, bounced perfectly off there. So we did sell a lot of our long position there. Have not flipped short just because the short-term momentum is down still in yield, but we'll be looking at another test of it. Might flip short. Best case scenario, I think maybe rates pull back to about that 280 level, and then the trend reverses higher again. So if you do, if you're looking to get a mortgage and you get that 280 level in the 10-year, I think you lock that in, because that might be the best rate you see, at least in my lifetime.
Okay, great advice. Okay.
Yeah, I want to see. Despite I mentioned earlier that eventually I think we do go to new lows in the market, and I think we're in the longer term. I think we're in big trouble just because of the macro excesses in the market, which have hardly. Here, I got a couple charts for you. So from a long-term perspective, there are a lot of excesses that have been built up in the system that are not going to be, kind of worked off real quickly. So here's one, is the household stock investment. So this obviously goes as a long-term chart. So in the blue line tells you how much households have in stocks. And recently, you can see at the start of the year, we went to an all-time record above that 40% level. And based on that, the forward returns in the S&P have not been good. The red line is inverted. So every time we've gone to a peak in household investment, the forward 10-year return has gone to about zero or even negative at times. So if history is any guide, we're up in the range where, where S&P is negative or basically unchanged over the next 10 years. So there's a lot of excesses to be built out there. And then you go to the Buffett indicator as well. It shows a similar story. Market cap to GDP, he likes to look at, and has made that indicator kind of popular. So again, we went to kind of
the sky,
point where market cap has doubled GDP, which the previous record was 2000, which was about 150%. And we have pulled back this year during this pullback, but only back down to about those 2000 levels. So we're only back down to the previous record. So from a long-term perspective, a secular perspective, we think we're in trouble for the next perhaps decade in terms of stock investment. And if you look at the bond market too, the charts that we just looked at, you look at a 60-40 portfolio, that's in trouble too. If the bond market is going to be, it is in a long-term bear market as well. So it could be we think it's going to be a very difficult environment for stock and bond investors. So
is it a time you like the dollar, yields are going up? Is it the time for people just to sit in dollars and 90-day T-bills and just collect safe money returns?
Yeah, I mean, there are long periods where two things, there are long periods where, they say it's more important the return of your capital than return on your capital. And this will be one of those environments. And then the second thing is that it's not like there won't be big opportunities along the way. Again, nothing goes in a straight line. These bear market rallies are explosive. Even the counter trend moves in the bond market, like we're seeing now, the counter moves in the dollar, like we're seeing right now. So I think either you sit in something where you're not going to lose money, or you find, and this might be the wrong crowd I'm talking to, because you guys are probably, believers in an active risk managed strategy. There's no buy and hold. There's no passive investment. But for 99% of the population, they need to find someone that does
tactical
manage. Tactical. They manage risk. It's not always buy and hold. There are opportunities both ways. Find someone that will move your money around to, at least, try to capture some of those the bigger trends, if you're not not in there day trading or anything like that, but manage risk and try to capitalize on some of those opportunities along the way. But certainly over the next several years, I think managing risk, avoiding losses is going to be kind of the name of the game.
And being a stock picker is going to become more important as well.
There'll be areas of the market that will fare okay, and it might be international markets, so you have to have a wide net.
What about China? Is it I know people say it's uninvestable, but they've been on fire. Are they untradeable in your work? Do you ever do anything in that stuff?
We do. We're like I said, you have to, this type of environment, especially, you have to have an open mind about where you're going to go, and especially as believers in relative strength. Whatever's working, we're going to go there. We don't try not to have a bias towards or against anything. Don't have a perma position. Don't be a perma bear or bull in any market. So we do have an open mind. Recently, we were short China, looking at if you go to the just looking at the the Shanghai Composite.
Okay.
Which has had a nice bounce. Obviously, we were short, got short here in June as it challenged that 61 retracement. This was a great trade for us. Came down, tested those lows from the spring, covered our shorts there. It's had a nice run. We have not jumped onto any of the Chinese internet companies or anything like that. But yeah, you got to have an open mind about investment possibilities, investment opportunities, especially in a challenging environment when the macro trends, I think, are lower for the most part in most markets. But here's another one. Okay, so one of the best looking charts out there. Here's the hedged equity Japan fund, right? So how many funds do you guys own that are at all-time highs? Probably not that many, right?
Yeah.
So DXJ is the ticker symbol here. Broke out to all-time highs, and this is actually a good spot. Pulled back to that the breakout area, that 23 retracement from those spring lows. Good spot to add some there, or if we do pull back further on that 65 level. So there's always opportunities out there, right, Dale?
All right, and you know what? This is your era now coming in. So what's the best way? You want to show your website, Dana?
Sure.
So you handle IRAs, you handle cash accounts, you handle all kinds of accounts. So
yeah,
perhaps people that have been, the whole ball game changed with the Fed this year, have been passive and may be looking for a more active manager. Maybe people give you a call and talk to you about what you're doing.
Yeah, so sure. We do our main business is managing money. A lot of retirement accounts, like you said. This is one area. There's another service that we started. It's called the Lyons Share. You can find it at lionsharepro.com. If you're a do-it-yourself trader, like most of your listeners probably are, we kind of share on a daily basis what we're looking at as money managers, what we're looking to invest in, and actually what moves we are making. So if you want to follow along what we're doing, if you don't want to, if you like doing it yourself but want some guidance from a professional risk manager, you can find help here. But J Lyons Fund Management is the name of our registered investment advisory. So if you're looking for money management, you can find us there. If you want to email me, info@JLFMI, you can email me there, or dlyons@JLFMI. Be happy to start a dialogue for sure.
Okay, or on Twitter @J Lyons Fund Management. James,
yep.
Dana, I want to wish you great holidays and an excellent 2023 ahead for you and your family and the people you work with, and want to thank you for your contributions to F.A.C.E over time.
Yeah, I appreciate it, Dale, and same to you and yours, and appreciate you having me on. It's always fun talking.
Good hunting, my trading warrior brother.
All right, take care, Dale.
Dana Lyons, everybody.
Merry Christmas.
Merry Christmas, buddy.
Yep.
Thank you, Dana. Everyone's thanking you. It's been a long time since seeing someone working on meta stock. Love it.
Yeah. I'm old school. All right, take care, Dale.
My email address is AOL. How about that?
Wow.
Can you top that? All right.
No.
Anyway, all right, Dana. Thank you, and
take care, brother.
All right, and everyone, you could join the team in 15 minutes on the Morning Edge. Don't just count your pips, count your blessings. Stay healthy. Wear a mask indoors at stores and stuff. You don't want to feel like I do right now. I'm telling you. So enjoy the rest of your day. Get ready for a big week. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.